This is a different platform than we were using before, but
really?
It's gonna be it's gonna be higher quality. All right, folks, give me a second. I believe we're streaming live. Give me a second just to verify. I am excited for this because I have not seen Will Rhind in 5 years. He's been traveling across Europe and Asia, and I think he went to Mars also to meet up with Musk. This will be a good conversation with Vitaliy Katsenelson, who I've gotten to know for the last, 3 years now. Vitaliy, probably.
Yeah.
We've been chatting. One of the more thoughtful value investors out there. For those that are watching this live, we can see your comments, we can see your posts, which means if you want to engage and ask questions, please comment on whatever platform you're watching on, and we'll try and bring that up. This is the High Conviction Podcast by GraniteShares. My name is Michael Gayed. Our guest for the Rough Hour is Vitaliy Katsenelson, and then, of course, my co-host is Mr. Will Rhind, who is back from a very long trip. Welcome back, Will.
Thank you. And yes, it wasn't literally 5 years, more like 2 weeks. But
and it felt like 5 years.
I feel like 5 years with all the travel. So I was in Asia for a couple of weeks, did a number of countries there, came back from Australia just earlier this week. And after a lot of those flights, it can feel like years sometimes.
So can value investing when you're hoping that that it's going to try to find a transition. So Vitaliy, introduce yourself to the audience. Who are you? What's your background? What have you done throughout your career? What do you do now?
Well, I'm a diehard value investor. I live in Denver. I run a value investment firm called IMA, and I used to. I also like to write. So my articles, people can find on a website investor.fm. And that's me.
Very good. So for those that don't know me, as Michael said, I'm Will Rhind, founder and CEO of GraniteShares. We're an ETF issuer, so based in New York City, specialize in the creation and issuance of exchange-traded funds or ETFs. We manage just over 10 billion, majority of that in the US, also Europe and Asia as well. So pleased to be on the show as usual.
I will start us off because we were just talking about this a little bit before the show. We got to define what value investing is. I'm sure, Vitaliy, you've seen that meme that's going around on X where somebody has the Graham and Dodd Intelligent Investor book and it's going to be thrown out in the garbage.
Yeah, it's right in the
right. Which is really actually like perfect the way it's used. But let's define value, and let's maybe go through a little bit of a history lesson in terms of how value historically has been defined versus how to think about it today.
Sure. So I think the kind of what you just referred to is the intelligent investor was basically kind of is the Bible of value investing. The thing is, when you look at this Bible of value investing, when you read it, you can either get a philosophy out of this, or you can get basically a cookbook, basically, which gives you a recipe. And the recipe, if you read it, if you read it kind of without looking for philosophy, is this: buy something that trades at, and then 10 times earnings, 5 times earnings, price to book less than whatever. And that strategy has worked for a long time before the markets, before you didn't have everybody had a computer on their desk, and before all the information was up. Today, basically that doesn't work. So what value investing is actually philosophy, and it's philosophy that's very, very simple. And this, the approach is this: you want to buy company. You look at companies not as pieces of paper, but as businesses. You looking for margin of safety, so you want to buy them at discount towards their worth. I didn't say cheap. I didn't say statistically cheap, but you want to buy them at discount what they're worth. And you basically, and you have a long time horizon. Mr. Market is there to serve you, not another way around. In other words, it doesn't matter. The market has an opinion on my stock 500 times a day, and that's all it is, just an opinion. So you look at this, that's basically a philosophy. That's what value investing is about. It doesn't mean that you own statistically cheap stocks. And that's a lot of times it's confused, because it's a lot easier to think of value investing as just kind of owning statistically cheap stocks. That's not what value investing is. You're buying undervalued companies.
So maybe, again, this is kind of an interesting point, because I think most people that are hearing this probably understand the philosophy, but I think the question is, when we're at markets are at all-time highs, and clearly we've been going up now for some time. How do you find, or are there any discounted stocks or stocks trading at a discount, and how do you sort of navigate that when markets are like this?
It's a great question. It is very difficult, right? Because when everything went up a lot, and every market has a lot of high quality companies out there, but them trading at discount to fair value becomes more difficult when the market is making all-time high. And if you look at the U.S. market today in general, it's very, very expensive. So the way we have dealt with that, basically half of our portfolio today is in Europe or outside of the United States. And the reason for that, because there we can find companies that trade at half of valuation of kind of American counterparts or less, and they still have significant margin of safety. So we still find a few values in the United States, but I wouldn't have a portfolio of them today.
Yeah.
So this is why we find a lot more of them in Europe.
And is there a particular type of company that you look at?
And this is what I'm about to tell you. It doesn't mean that everybody else should do this, but I find that I'm a lot more rational when I own high quality companies. And high quality companies, it means that companies has a significant competitive advantage, has strong balance sheet, run by very capable management. So that's what's high quality companies to me. And you can find them in any market, right? It just find them at the right price. That's what makes it difficult. And like today, we own a lot of defense companies, for instance, and we owned them for a while. And I love European defense companies, actually more than Americans, because Europe has been underspending on defense for the last 30 years. And you guys know obviously what's happening in Europe and what's happening and what's going on in China and the Middle East. So our European defense spending will be going up for a long, long time. So that's in part, that's a good part of our portfolio, kind of European defense companies. Also, one of the you asked me a question about value investing and what is it. So our second largest position actually is Uber, which is not something you would expect to find in a kind of value manager's portfolio. We owned Uber for 4 years, and we bought it right before the pandemic. Except when I was buying it, I did not know I was buying it before the pandemic. I was just buying.
Hold on. When you're prospecting,
that's a totally different story.
Yeah, and when you're prospecting, you tell the prospects that you got to tell people that you want business from.
That's right.
Coming, right?
That's right. And we were buying a company that we felt was undervalued. It was one of the most hated stocks we ever owned at the time when we bought it, because at the time, every major newspaper was writing articles how this company lost more money than socialism, and it will never make money again, etc. And our insight about Uber was very simple. Unlike this, if you look at kind of a pure digital companies like Google or Facebook, Uber is a kind of a combination of digital and analog company. And what I mean by this, big part of the spending goes on writing software, and basically kind of R&D. But also a big part of it was actually going on, all the legal fees and regulatory fees and recruiting drivers. It was kind of an analog business, And my thought was that this is a business that has a much higher fixed cost structure than your typical digital business. And as its revenues continue to grow, and I figured that Uber is not just competing with taxis, it's competing with your second car, it's competing with your DUI ticket because you drove while you were drunk, or your brother's taking you to the airport, this kind of thing. So the market is huge. And as the revenues continue to grow, the costs will flatline and the margins will expand. And by the way, that's what actually been happening last year, right? Its costs basically flatlined, and revenues continue to grow 20%, and earnings are growing at much higher rate.
Yeah, certainly the stocks turned around, or the companies turned around massively
Yes.
in the last couple of years. So kudos to you for spotting that or getting that about the right timing.
Oh, thank you.
Is it fair to say then that part of value investing is just looking for very high operating leverage companies where they get to that inflection point where the margins can just explode, and you can't rely on historical margin, metrics?
So I think let's talk about, so there is a value in growth. In other words, a company which earnings will go up from $2 a share to 10, it may look expensive on today's earnings, but actually may be undervalued based on the future earnings. So it's actually be able to see past today, be able to see in the future, and be very comfortable have high confidence in those $10 earnings. That's okay. The whole term value investing is a bit redundant, and I think they kind of Buffett and the Munger and the Ben Graham had to use this term because at the time when they started investing, people were basically just speculating. Okay, so but value investing, I mean, it's not that much different than you just buying. Like when you buy, Michael, if you were going to buy another investment firm, or Will, if you were going to buy another investment firm, you would be looking at the cash flows, right? You'd be looking at the threats. You would be looking at how much cash that company has, at the management that runs it.
Yeah,
that's really just investing, right? I think it has to be the term value investing is used because of kind of it's redundant just to kind of to make sure to tell people, yes, I am invested, I'm not gambling. Now, Michael, about Uber, I think it's just one of the, like as an investor, you're looking for different mental models. Like sometimes you want to buy cyclical companies when they look very, very expensive and nobody wants to own them, kind of because at the bottom of the cycle. You want to buy companies like Uber, that's a different mental model where company has a high operational leverage and it's under earning because its revenues are too low. So that's just, so as an investor, what you want to do, you want to start collecting different mental models and which apply, let me give you another one. Let's say you have a company that has a very profitable business and has another business that's losing a lot of money. Okay. Now if that business at some point turns profitable, then suddenly the earnings for the combined entity will go up a lot. Or in the worst case, if that business will never make money, company will shut it down and sell it, and earnings go up because losses will go away. So that's another mental model. So as an investor, I constantly look for mental models and then you see a stock and you see a company, you say, oh, it fits into this mental model.
How important is the macro? So you mentioned I thought it was a good example about the European defense stocks because, a lot of people, I guess a potential counterpoint, to the value argument, especially when you say, okay, well, there's not necessarily value stocks here in the US. So we buy a stock in Europe or in China or whatever it may be, whereby the valuation for let's call it equivalent company is significantly lower. But there's that potential, classic bear trap where there's a reason why there's a discount. And that's because there's no growth in Europe or China, whatever it may be. How do you look at the macro and like how does that sort of fit into your thesis?
I think that's a great question. Thank you for that. I think in the past, value investors, especially before 2008, were basically saying, we don't do macro. And I think they copied Buffett, but they copied him in the wrong way, because Buffett would say that he doesn't care what the interest rates are going to be tomorrow or what the Fed decision is going to be tomorrow. And because he didn't, it's almost like he was trying to forecast weather. Buffett did not want to do that. But what Buffett did care about is kind of a climate changing events. Okay. And value investors basically just took it as macro doesn't matter. Therefore, even if there's a housing price at all-time high, I'm going to ignore this kind of stuff. And we know how that worked out. So I think macro is very, very important. And like some people say I'm top bottom, but some people say I'm bottom up. And I'm saying I'm just thinking. I'm just doing both. Because like when it comes to European defense companies, that's basically, you could argue that's a macro bet, right? But also macro analysis is just part of any analysis, right? Because when you analyze a company, and when, like, let's say it's in Europe, and Europe has slow growth, that's one of the inputs that should be going into your analysis. Or when you're analyzing a company that's in a country where you may wake up one day and discover that you don't own the shares, because the government changed the rules, like China or Russia. That's very important part of the analysis. So to me, it's something you always should pay attention to. And instead of trying to kind of focus on macro, try to figure out what the interest rates are going to be tomorrow, whatever, you should just kind of look at the big risks and just do analysis when and factor that into your analysis when you analyze a company.
Do you have more, I guess, more stocks or more investments in Europe or other international countries outside of defense? Any other particular sectors that you like, or
so that's a good question. We own. Let me see. I'm trying to think if there is a theme to them. The biggest theme in our portfolio today is defense, which is kind of European defense. And then we own a Japanese small cap. I just went to Japan a couple months ago, and we own a Japanese small cap, micro cap. It took us a month to accumulate. That's how illiquid that is. Yes. Wow. So that would be because if you look at Japan, like large companies that are very liquid, they're basically they ran already. They're most of them are fairly valued. And then what I'm looking for idiosyncratic bets, when we look at Europe, I'll give you one example. We own an Italian bank, which just sounds like a kind of a huge value trap. And it's a company called BFF, and we are it's a $2 billion market cap bank, except it's a bank that it's not in the lending business, and it's in a factoring business. In other words, when Pfizer sells drugs to Italian hospital, the payer is actually not the hospital but the Italian government. So the company, there is no default risk, because it basically, if you think about factoring, is a term of lending. On the other side is actually Italian government that can't really default. So you find these kind of situations, and a company trades as just another Italian bank, while Italian banks trade maybe 7-8 times earnings. This company has return, and a typical Italian bank would have return on equity of 10%. This company has return on equity of 25 to 30%. It doesn't have a default, basically has no credit risk, and it has a 12% dividend yield. So you won't see opportunities like this in the United States. So that's why we have to spend more time looking at, outside of the United States.
It's a good question from Jose here watching on YouTube. Vitaliy, I recall you're a student of the Austrian School of Economics. Do you think this school of thought helps you develop mental models, the mental models you refer to?
Well, Jose, thank you for the question. Well, I think I became a student of that School of Economics because I grew up in the USSR, which was not, which had a different, which belonged to different School of Economics. And so, I'm a big believer in free markets, because I've seen the alternative, and I'm not a big fan of the alternative. Yeah.
Going back maybe to Uber for a second, couple of different sort of streams of thought here. But the first one is obviously Tesla, Elon Musk are in the news constantly, but even more constantly than normal given the election result. Mm-hmm. And one of the big things that people are talking about is the potential for full self-driving or autonomous to be accelerated under a Trump administration.
Mhm.
Is that sort of part of thinking on Uber, or what do you think that means for Uber?
Okay, so I think if you first, it's several questions outside of this one. So self-driving, I think self-driving is in the future. The question is when. Okay, now you already have a Waymo self-driving in certain parts of California and I think Las Vegas as well. Now, the self-driving that exists today, if you think about where Waymo is, it's basically in cities where the weather is almost perfect all the time, where it doesn't rain, there is no snow, and it's rolled out in very discrete neighborhoods. So it's a geofenced. So self-driving works perfectly in those areas because they're mapped out for perfectly. Obviously, over time, it's going to expand. Okay, so the problem is, you're going to have not just Waymo, but you're going to have other self-driving companies. When you are a customer who wants to get a car, what you really care about how fast you get the car, and then you care about the price, and then obviously safety. So I assume that self-driving will become available when it becomes safe. So as a customer, you care about you push the button, the car comes. Now, the problem with the self-driving issue is this: you have different demand at different time of the day. So at 2:00 in the afternoon, demand for self-driving is a lot less than at 5:00, and therefore it makes no economic sense to have enough cars on the road available throughout the whole day when the demand for those cars is only high at 5 p.m. from 5 to 7 p.m. So therefore, this is where I think the future of autonomous is going to be. Uber is going to have self-driving and is going to have driver-operated cars. You push a button, and the car is going to come. It's going to be from Waymo or Aurora or whoever else. They're all going to be on Uber. They're all going to be on Uber platform.
Yeah. But wait, that's interesting. So if I'm hearing you correctly, you're saying that the future, at least maybe in the shorter term, but perhaps in the longer term as well, is a combination. You're going to be summoning a car, say on the Uber app, but that car could have a driver or not have a driver. But there's room for human drivers as well as autonomous.
Oh, first of all, it's going to Well, it's a great point. Let me just be a little bit more specific here. Okay. Number one, it's going to take a long time for self-driving to be available across the country. Sure. And the reason for that is very simple. I own 2 Teslas. And whenever I drive my Tesla and it snows or rains, my self-driving stops working. So you can't really have a service that only works part of the time. Okay, so therefore the human drivers are going to be there for a long period of time. At some point, self-driving will get to the point where it's going to be safe in any weather. Not today, and it's going to be a long time before we get there. So the reason I brought up San Francisco, Las Vegas, or Phoenix, because the weather there is very, very, very stable. It doesn't rain a lot, etc. So in Denver, it rains, it snows. So if you want to have a predictable service, the drivers are probably going to be a big part of the platform. And on the great sunny days, you can take Waymo, again in the very narrow, geography. Another point, and this is very important. I have the latest update from Tesla of full self-driving, and it's great 99% of the time, but 1% of the time it's going to drive you off the cliff, which is kind of, and I think this is kind of the issue. I mean, it's working much better today than it did years ago. It is really much better. But again, it's still I would not put my kids if this was available as full self-driving and not geographically fenced, I would not put my kids in that car, and it's just not safe. So Musk, Tesla went up probably by $300 billion. I don't know how much it went up since Trump got elected. But still, at the end of the day, you're going to have a few car accidents where people die in a full self-driving car. And it doesn't matter who's in the White House. People just will not be using the service. So when the day Trump got elected, Uber shares declined. I'm not really. By the way, today we're not buying the shares because I think we own it, and I think it's still undervalued. Yeah. But the margin of safety is a lot less than it used to be in the past. But full self-driving is not something I'm worried about. When I own Uber stock.
The other thing I wanted to ask you about it is, especially coming back from Asia, right? There's you have real super apps in Asia, which don't really exist here in the same way that certainly some of the Chinese ones. Now, Uber would be a company that would, I think, be one of these firms that's trying to create more of a super app, certainly add more services. Do you is that part of the thesis? Do you think that that's likely to happen? That's a driver of growth for the company going forward?
I'm somewhat conflicted about this because I think they've done a good job integrating Uber Eats into in the super app. The question is, are you going to be buying when you think of travel, do you think of going on Uber and buying your airline tickets? I'm not sure about this. I'm not sure if they can change our behavior and condition us to think in Uber this way. I can see us thinking about Uber when we want to, take a car, send a package maybe, and they already have this service. Maybe rent a car, possibly. But I know that like Dara or somebody, like I read a story that one of the Uber executives went to Asia, saw a super app, and that's when they start to work on the super app. It's the question. It requires to change consumer behavior drastically in the United States. I don't know if they can do this or not.
Yeah.
But so far, they've done a very good job of kind of coming up with new use cases for Uber. I'll give you an example. My brother's father-in-law was in the hospital, and my brother had to leave the country. And he asked me to take care of his father-in-law if he needs to be picked up from the hospital on another part of town. So when his father-in-law called me, I went on, and his father-in-law is 80 years old. He's not going to use Uber. I ordered Uber, and Uber identified that I'm not the one who is at the hospital. And Uber asked me to put his father-in-law's phone number, and Uber texted his father-in-law when the driver was there. So now there's other applications, so you don't even have to have a Uber app to be able to use it. So they keep trying to increase use cases for Uber, and so I think that's basically my kind of my bull thesis.
Yeah, because that was in the news very recently that they were potentially going to make a bid for Expedia. Was it Expedia or Booking?
I think Expedia, yes, because Dara used to be.
Dara used to work there. Yeah, exactly.
I doubt they're going to do this. I think in a conference call they talked about, and I think they tried to send a signal that they'll make small acquisitions if they do, kind of adjacent acquisitions. But Expedia, that's a business change. I think they bought a company somewhere in Asia, like was in a similar business. I forget the name of the company now.
Yeah.
But I don't think they're going to be buying Expedia. That's just, it's too expensive and it's just too much risk.
Yeah.
So this is a naive question for me, but why Uber as opposed to Lyft?
Oh, that's easy. So Uber is in 40 countries. I forget, in 40 countries and hundreds of cities. So the R&D, think about, they're able to amortize it R&D over 40 countries. So in other words, the R&D per ride is much lower than Lyft. Also, they own Uber Eats, and I never looked at Uber Eats as a kind of great business, but I think it's strengthened the moat of Uber because of the Uber One app. So I think until recently, I could say Uber had a much better management. Lyft has new management, and I don't know I don't know much about the new management. So Uber has a so much stronger competitive advantage. And also, like if you have an Uber app in the United States and you go to another country, you just keep using the same app. So, this is where they have a lot more data. They have a lot more data, and data becomes very, very important in this business. So yeah, and also if they make partnerships with self-driving, with full self-driving companies, they're probably going to go to Uber, not to Lyft, because they can make one deal and it applies to all markets. So. Will, is that your? Do you have anything to add on this, or?
I would say that the only thing I would add to that is I think that you could make an argument for a lot of these companies, the direct comparison, when we had zero interest rates and money was really cheap, and for both companies, they could pursue that sort of strategy of growth at all costs. Yeah. And I just think Uber was further down the line, clearly first mover advantage. Mm-hmm. They got into other businesses, which they were perhaps criticized for at the time. But when the music stopped, Uber was the one that had the bigger market share, the bigger scale. And obviously now with interest rates repricing everything, that the cost of that growth now is just exponentially different than it was a few years ago. So I think Uber becomes the clear winner because it's sitting in that scale position, or that position of market dominance, in a way that now for a Lyft or for anybody else, the cost of that growth is just so much higher now.
I think that's a great point. I think Uber, and this applies to Lyft as well, that point applies to, has actually benefited from pandemic in this way. First of all, it created Uber Eats business on much greater scale. But as importantly, because Uber's survival was at risk, they had to cut costs tremendously. And therefore, the cost structure they create, because when they went into pandemic, they had a bloated cost structure. The pandemic basically gave them a permission to create a new cost structure that when they came out of the pandemic, they became a lot more profitable. They cut a lot of costs. And I think, Will, I like your point about the how crazy the market was. I call it the WeWork moment. The craziness stopped when WeWork went bust, because the funding just dried out for all this. In all these companies had to figure out how to make money without burning a ton of cash.
Yeah, and a lot of them. I mean, especially I know our own space, much better, which is in wealth management, asset management, fintech, and certainly in our space, the cost of acquiring customers is significantly lower when money's cheap and the market's wash with liquidity. But the moment that changes and suddenly you realize that the cost to acquire that customer goes up massively, then it's no longer, a lot of these models then just don't work. And that's why you've seen this kind of the age of the incumbent, right? That these upstart challengers sort of got to a certain point, and if they were acquired, then great. But if they didn't get acquired, the incumbents were able to sort of fend off that challenge quite easily in an environment where now acquiring customers comes at a real price.
That's right.
Are there so that's a non-traditional example of what you consider to be an undervalued company. Of the other major stocks, large cap, mega cap, tech in particular stocks out there, is there anything else that is considered value in your mind?
Yeah, and you don't have to be invested in it. Just more like
right. No, I tell you the anti-value. We used to own a lot of Apple, and we bought it when everybody hated Apple, when it was trading at insane valuation, and then we sold it. And we sold it, I would argue, too soon, and we made a mistake. So part of us selling was a mistake, and mistake was when we analyzed an Apple and we were modeling it, we assumed that this decline in prices of the products, and this is where I was mindless. Because I was thinking, well, prices always decline in consumer electronics. Well, except for Apple, right? Because they actually became such a strong brand where they actually were able to raise prices. So that was a mistake. But I look at Apple today and trades at, I don't know, 30 something times earnings. And I look how every time for this valuation, the Apple is already a mature company. I mean, the iPhone is already a mature product. The only thing that's really growing for them is services, and it's a high margin business.
Mhm.
But it's incredibly difficult for me to look at Apple and say, at this price, I'm going to make any money over the next 10 or 15 years. I mean, in best case, you're going to break even. Most likely, you're going to lose money just because it's already such a large and mature company. And
Yeah.
it seems like every time they need another iPhone-like product to justify this valuation. They tried it with car. They failed at that. They tried it with Vision Pro, and I think that's going to be a failed product. So it's Apple basically kind of became a religion stock. It's like, because everybody who ever bought Apple in the past has made money, and therefore every time you sold Apple in the past was a mistake, and therefore
Yeah.
today it's only bought. But at some point, I think at today's price, it's priced for perfection, and not for the future that they will be able to fulfill, basically.
So the Apple bulls would say that the future of Apple is all about AI,
Mhm.
and particularly being able to integrate AI into the platform in a way that perhaps so far Apple's been a laggard in the AI race. Do you buy into that at all?
Well, I think it's going to become a table stakes for any device, right? But are they going to make, are you going to be willing to pay a lot more money for iPhone because it has AI in it? I mean,
That's kind of the core. Well, the main core of the thesis is that the
that's
upsell cycle, etc., accelerates because people want the latest AI features, and that becomes the race that we've all been living ourselves over the last decade or so, albeit with small amounts of gig improvements or whatever other little features, better camera, etc.
Well, I think, yeah. So I think you're making a good point. So so in the past, you would buy a new iPhone because it had new features, and that created this upgrade cycle a little bit faster. Today, like, I don't know what I have an iPhone here. I don't know what number it is because they don't really change. Now, could AI, let's say the new model comes out and it has AI and it's not going to work on my phone, would I upgrade? Sure. But here's the key. Value of any asset is the present value of its future cash flows, not next year's earnings, but cash flows going out decades into the future. Just because they accelerated the future upgrade cycle for a couple of years, that's what happens 3 years after, 5 years after. The upgrade cycle will go back to what it was before. So I think Warren Buffett is making the right decision by offloading Apple. And so I would be doing the same thing if I was smart enough to hold it this long.
I love that point. It's like everybody that made money in Apple, it's like, they're the ones that keep on buying into it because they've had such a great investor experience. Could you make the same argument about Nvidia?
So Nvidia is more complicated. Nvidia, to me today, looks like a company that is a temporary monopoly in this very narrow space of chips, and where its customers are I forget, 30 or 40% revenue comes from Google's and other mega caps who are buying the chips, and those companies don't like Nvidia's margins because those margins comes at their expense. So Google and Facebook and Tesla and all of these other companies are working on their chips. So what's going to happen at some point in time? And this, by the way, when I think of Nvidia, I keep thinking about late 1990s and telecom boom, where like Quest Communications, Ciena, JDS Uniphase, all these companies were trading at the same valuations, and the earnings were growing very fast because we were building out fiber optics network. But the problem is everybody was doing it at once. At some point, we had too much of that. So I think what we're going to discover is that the Nvidia today does not look statistically expensive. I mean, it's traded, I don't know, 30, 40 times earnings, not insane number, like, for companies growing this fast. The problem is, I think it's the only game in town, and therefore it has the margins as if the only game in town. I think the semiconductor cycle will catch up with that, and it's going to go through, like right now it's in the boom phase, it's going to have a bust. I don't think it's going to go away, obviously, but I think the margins could come back to 20 or 30%, and the revenues will decline as well. And suddenly you figure out that it's not really trading at 30 or 40 times earnings, but trading at 500 times earnings, or whatever that number is. So I looked at Nvidia, and I mean, I'm not sure which ones. I'm probably worried less about Apple than I'm worried about Nvidia. And you already know what I think about Apple, so I'm not that excited about Apple. So if I want Nvidia, I would be worried a lot more about it, because I think there is a good chance. Let me give you this example, which I think is going to resonate very well. In 1999, Qualcomm was the company to own, and it's very important to understand, like Qualcomm in 1999. Qualcomm basically has a toll. They charge it for every cell phone sold globally. They receive 3 to 5% of the sales price of that phone. Okay, in 1999, the stock was trading, I forget, at $80 or $100. So no, maybe more than that. And over the next 15 years, what happened to next 20 years, what happened to mobile phones. Mobile phones went from nothing to insane, huge market, and you could not find a better company positioned to make money on that, because they collected toll from every single device sold. Here's the key: if you bought Qualcomm in 1999, you were down 80% for the first decade or two, or maybe first 10, 15 years. And I'm not sure if you're breaking even today. You may be still down from 1999 point, or you may be making money now slightly, but it took 20 years for people to just basically to break even on that investment, even though that company was perfectly positioned on this incredible tsunami of mobility. So it's kind of like Nvidia, right? It's perfectly positioned on that, except it's a $3 or $4 trillion market cap company in the business that has its own cycles. It has a peak margins today. So yeah, I look at Nvidia and I say it's a great company, probably horrible investment over the next 10 years.
It was interesting. You actually said something I was kind of surprised that I thought you were going to say it was really expensive. And it kind of comes back to the part of the valuation or the value investing sort of mantra, which is about the valuation itself. And the fact that what sometimes people forget is that, it's a multiple of earnings, of course, but factored into that is the growth. And, when you look at the Nvidia earnings and you think that the company's basically pricing for 100% growth, then the multiples that you see actually look very reasonable compared to other companies that might be in the peer group. So it is an interesting sort of reference point in terms of how you think about that valuation.
We talked about Uber. So
yes.
Nvidia is kind of like the inverse of Uber in this way. When we looked at Uber 2, 3, 4 years ago, it had no earnings. But then you basically looked in the future 5 or 10 years out and said the earnings are going to be much higher. You look at Nvidia today and you see huge earnings. But then I look at the revenue, I look at the earnings 5 or 10 years out, and I say the earnings are likely going to be a lot lower because there is a lack of competition today, and for that reason there is the profit margins are unsustainably high levels. That's what I think about basically Nvidia. Yeah.
That all hinges on the AI being the fourth industrial revolution or not.
I know it is absolutely. And I tell you this, I talked about this in one of the articles where in 1800s, trains revolutionized basically. That was part of the industrial revolution, right? Would it be a second one? I don't know which one. Probably I don't know which one, first one or second one. The trains were a huge deal. They allowed to carry coal from one side of the country to another. Huge. It was then it became trains became very important for passengers, etc. And what also happened, you had a bubble develop in the UK. I'm talking about England. Everybody became believer that trains are going to change the world, and you had a huge bubble in the train stocks. And even though trains became more and more important, those stocks collapsed. So the price you pay actually does matter. So that's kind of that's the point I'm making, is that you could have a great company that is making a great product, but it can still get overvalued. That's where I was going to go with that.
Yep, no doubt about that. But I think at the same time, let's go back to your Qualcomm example.
Yeah.
From the tech bubble, you still have today. You still have Apple, still have Microsoft, still have Amazon, and from that perspective, you bought those at the top. You've still done well, and so there's like an enduring quality to good companies. And I'm not trying to make the point that anything's going to last forever, but clearly you can be in some companies for a long time. And some companies can survive and thrive for a long time.
So yes, but here's a very interesting nuance here, because you're right. If you bought Amazon, let's talk about Amazon is kind of more difficult. Let's say Microsoft, right?
Yeah, Amazon was a small, obviously a much smaller company, but
yeah. But look at Microsoft. Microsoft is an interesting example, because if you bought Microsoft, you would probably for the next 10 or 15, I don't know if you can look at somebody can pull up the chart, for the next 15 years, you were down a bunch. And it's only after 15 years you broke even, and then you made a lot of money. And by the way, after that, you would still have like if you bought it in 99 and held on to today, you would have an okay return, not still reasonable return, but you have this. How many people are going to endure 15 years of like basically either negative or no returns? And that's my point. And that's the point I'm trying to make.
Yeah,
is that you buy Nvidia hypothetically, maybe 20 years from now, it's going to be still a great investment. But my God, the next 10 or 15 years could become so miserable. That's
Yeah, no, exactly. So therefore, that again leads us on to another kind of interesting thing, which is the when to buy, when to sell, and perhaps more when to sell, more relevant to this. Do you have any rules or methodologies that you go by in terms of how to handle that?
I mean, selling is probably the most difficult part of investing, right? And I have modified my sell discipline based. Let's talk about this. You basically sell stocks for 2 or 3 reasons. Number one, you bought a company, you had a certain expectations, fundamental expectations, and you were wrong, or something happened.
Yep.
So that's one reason to sell the stock. Something didn't work out. Okay. And that's difficult because you have to admit to yourself that you were wrong. Then you have a second reason, which is kind of a happier reason to sell. You bought a company, it went up a lot, you made money, and then what? Now, this is where I changed the way I look at this now. I used to be kind of, when I bought a company, like the company went up a lot, I would just sell the whole position. Now my selling discipline will be different based on the type of company it is. If it's a slow growing company, I would be selling maybe in large chunks, maybe 30 or 50%. So I would be let's say I would sell 1/3 at 500, 1/3 at 600, and then the rest at 650 or whatever. Okay. If it's a faster growing company, I will be selling in smaller chunks, just because a lot of times these companies will surprise you. Like that growth, the compounding of growth is very, very powerful. So this is kind of like when I think about Uber fits into that category. We haven't sold a share yet, but at some point when I'll be selling in very small chunks. And another thing we did with Uber, actually, we hedged our position, half our position, and I wrote about this. When the stock was, and I think it's important to explain how we did it. And literally when the stock was at $80, we sold calls at 100, which basically would have to sell Uber at $100 if it gets to 100. And we bought puts at 70. So we had a 10-15% downside and 25% upside. And we did it only not on the whole position, on part of the position. Because so that's another way to deal with this kind of companies. You can argue that I would have sold Uber at 100 or part of the position. But selling is the most difficult part of investing. I mean, I told you, I gave you my example of selling Apple. And I cannot tell you how every time I look at Apple stock, I feel, there's this feeling of stupidity.
Whichever way you look at it, you can't get away from the fact that it's market timing. And,
no, it is market timing, and you know what? It's kind of I just came back from Japan, and in Japan they have this concept called wabi-sabi. I love the way it sounds, wabi-sabi, and it's just basically it's kind of good enough, And when it comes to selling, I kind of have this kind of good enough perspective, is that you will never get it right. And in fact, you should be prepared that you're going to be wrong. Yeah. And you just have to follow the same process over and over again and try to get better at this. And knowing that I will never sell the top. And it would be actually very arrogant for me to think that actually I'm good enough to sell at the top.
Yeah.
Speaking of should we do the closing question, Will? What do you think? The big closing question on your end. Come on now.
The closing question. So given we're on the High Conviction podcast, we always like to ask people what their highest conviction investment idea is at the moment. So it doesn't necessarily have to be one, but you had to pick one at the moment. What would that be?
I'll tell you, it's our largest position in the portfolio. It's a European defense company. Probably most American investors never heard of. It's called Babcock International. It's very important because there's other Babcocks in the United States. This is Babcock International, and this is a company that the second largest defense company in UK, and they basically train UK military, service UK submarines, and make ships. UK's Navy today is half or a third what it was 30 years ago.
Don't get me started.
Yeah, yes. So that's going to change. And so what we like about the company, it has very little debt, has a huge tailwind of growth ahead of it, has a terrific management. It's trades, I think, at 10.5, 11 times earnings, which is probably one of the cheapest companies in defense sector. And it's our largest position because when I look 5 or 10 years out, I can see the earnings being a lot higher. And they just in the last quarter, their revenues grew 11%. Not Nvidia numbers, but it's trading at 10, 11 times earnings that will be higher, and the margins will be higher. And so that's our largest position basically in the portfolio, and that's my kind of highest conviction idea today.
Well, I don't know what that necessarily says of the state of the world, but anyway, that's probably for another day.
Yeah,
it's probably bullish for Nvidia because it means it's going to be a bunch of Terminators that the defense companies are going to be buying up. Yeah, so
the AI and everything.
That's it.
Yeah, everything. Yes.
Well, the good thing is that this is the real intelligence on the High Conviction podcast. Appreciate those that watch this live. This will be an edited podcast on the GraniteShares YouTube channel shortly. Make sure you sign up, by the way, to our Substack on GraniteShares, graniteshares.substack.com. And we did actually get that question earlier, Vitaliy. Where can we read the articles of Vitaliy?
Okay. If you go to this website, investor.fm, like FM radio, that's where you can sign up for my articles and you can read them. They're all free.
And we'll post a link under that to the video.
Oh, thank you. Thank you.
Absolutely. Appreciate everybody watching. Like I said, welcome back, Will. I'm glad you're back. And Vitaliy, you're the man. I appreciate you joining.
Guys,
Vitaliy,
thank you very much.
Great conversation.
Thank you. Thank you.
All right. Stick around, Vitaliy, just for the recording. Just hold on. Thanks.